All right, welcome. Today, we're going to decode the real estate tax code. And what we're really doing here is taking a bunch of what seem like super complicated separate rules and showing you how they actually fit together to create one powerful financial engine.
So let's just jump right into the core idea, the central paradox that makes this whole thing possible. It's a question that honestly sounds a little crazy at first, but it's the key to everything.
Okay, so here's how we're going to tackle this. We're breaking it down into 5 key parts. We'll start with the engine itself, then we'll add an accelerator, open up the gateway, talk about the counterbalance, and finally look at the end game. It all builds on itself. All right, section 1, the core engine. This is really the foundation of the entire strategy, the thing that makes it all go. And it all comes down to one word: depreciation. You know, before we get into the what, it's really important to understand the why. The tax code isn't just a bunch of random rules. It's designed to make people do certain things. In this case, the government wants people like you to provide housing. So they've basically set up a deal. You supply housing, and they give you some pretty amazing tax breaks for doing it. So what is depreciation? Well, the IRS lets you take a tax deduction every single year because on paper, your building is getting older and wearing out. It has a useful life for residential properties that's 27 and a half years. The key thing to get, though, is that this is only for the building, the structure. The land it sits on, that doesn't depreciate. You can't deduct that part. And here is where it all clicks. This is that paradox we talked about. In the IRS's world, on your tax return, your building is losing value every year. But in the real world, what's actually happening? Your property's value is probably going up. This disconnect is what we call a paper loss. You're making money in reality, but you're showing a loss for tax purposes. This is the magic key. Okay, so we've got our engine, right? Depreciation is chugging along. Now, what if we wanted to add a turbocharger? How do we make those paper losses even bigger and, more importantly, get them a lot faster? Well, that's where something called a cost segregation study comes in. This is a pretty sophisticated engineering-based approach. Think of it like this. Instead of treating the entire building as one big block, you surgically separate all the pieces inside that wear out a lot faster than the walls and foundation. So you can see here, you've got the land, which you can't touch. Then you have the building's main structure, which you depreciate slowly over 27.5 or 39 years. But then you've got this whole other category. Things like the carpet, the cabinets, the appliances, even certain wiring. Those things can be written off way, way faster. We're talking 5, 7, or 15 years. And the result of this? It's massive. We're talking about being able to reclassify maybe 20, even 30% of the building's total value and deduct it much more quickly, often in the very first year. This front loads your deductions and creates a huge paper loss right out of the gate, which can have a major impact on your tax bill this year. Okay, great. So we've created this giant paper loss. Now what? How do we actually connect that loss to our main source of income? You know, your W-2 job or your small business, to actually lower that tax bill. And this is a really big hurdle because the IRS has rules for this. They put up what's basically a firewall. They say your real estate losses are passive and your job income is active. And you're not allowed to mix them unless you can find a way through the gateway. Now, according to the experts, there are 2 main paths through that firewall. The first is to become a real estate professional. This is a big commitment. We're talking 750 hours a year, and it has to be your primary job. It's often perfect if one spouse and a couple can qualify. The second path, which is really popular for high-income professionals, is the short-term rental strategy. If your average guest stays for 7 days or less and you're materially involved, you can often bypass those passive loss rules entirely. All right, now you might be thinking, this sounds a little too good to be true. And there is a catch. The IRS doesn't just forget about all these tax breaks you've been taking.
They have a way to balance the books, and it all comes into play when you decide to sell. And here's the crucial thing to understand. All that depreciation, it's not a tax-free gift. It's a tax deferral. Think of it like the IRS is keeping a running tab. And when you sell, they want their money back. They recapture all that depreciation you claimed and tax it at a special rate, which can be as high as 25%. But there is an incredibly powerful way to deal with this. It's a tool that lets you just kick that tax can down the road. It's called a 1031 exchange. Basically, you can sell your property, take all the money from that sale, and as long as you roll it right into a new like-kind property, you get to defer paying a single penny of that depreciation recapture or capital gains tax. Now, this power comes with some very, very strict rules. There's a ticking clock. The moment you sell your first property, you have exactly 45 days to officially identify your potential new properties. And then you have a total of 180 days from the sale date to close on one of them. If you miss either of those deadlines by even a minute, the deal's off and the tax bill is due. So we figured out how to create these massive paper losses and how to keep deferring the taxes on them, maybe for your entire life. So what's the end game? Well, this is the final piece of the puzzle, and honestly, it's the most powerful part of the entire strategy. It's a concept called stepped-up basis, and here's what it means. When you pass on and your heirs inherit your properties, the IRS essentially resets the value. The new cost basis becomes whatever the property is worth on the day you die. And what that does is it completely, permanently erases every dollar of deferred capital gains and depreciation recapture you've built up over the decades. It just vanishes. Yeah, it sounds a little grim, but financial experts have a saying for this strategy it's pretty direct. The idea is to just keep kicking that tax can down the road with 1031 exchanges for your entire life. Because that final transfer to your heirs is what makes the tax bill disappear for good. So let's put it all together. You can see it's not just a bunch of random tricks. It's a complete system, a 5-step process. First, you create the paper loss with depreciation. Second, you accelerate it with a cost segregation study. Third, you unlock it to use against your job income. Fourth, you defer the taxes with 1031 exchanges. And fifth, you eliminate that tax bill for your heirs with the stepped-up basis. Which leaves us with one big question to think about. Is this whole thing just some giant, unintended loophole that needs to be closed? Or is this exactly how the system is supposed to work? Is it the government's master plan, using these powerful tax incentives to get private investors to fund, build, and maintain the nation's housing? It's something to think about.